Guys, welcome back to the channel. So there's a new options ETF based on Tesla out. It's called TSLP, and I just wanted to compare this to TSLY. And I was wondering if this new company Curve can catch up to YieldMax. So let me go into some of the details here for you guys. So I think in general, it's always good to have like some competition, but I don't know if this new TSLP can really stack up. I think like right now, TSLY has a good advantage in terms of a lower stock price, and there's more of a track record. But I still wanted to go through TSLP just to see if in case there's anything that we can take advantage of. So I'm listing the website over here, and you can go through it at your own leisure. So right off the bat, there's might be some confusion here. Because when I pulled up their prospectus and other information, it says Neos ETF Trust, which isn't necessarily a bad thing. They have their own set of ETFs already, but why not just keep the Neos name? And why do they have to separate out some of these guys into Curve, which is a little weird. So as you can see, they're relatively new and like some of the things that I don't like right off the front, uh, right off the top, is that their normal expense ratio isn't that good at 1.15. So you're paying a little bit over 1% normally, but because there is a kind of like a rebate system for right now, there's like a temporary waiver until I think December 2024. So that lowers it down to 99 basis points, which is in line with Tesla. But why not just keep it at 99.99%. It seems a little too gimmicky to me. And then also because you're a challenger, like why not uh just undercut them by cost and like maybe make it 90 basis points or 85 basis points. Like how do you expect to catch up? Unless like you can offer a superior yield, but like the fee structure I'm not too thrilled with. So and it just the good thing is at least it's a similar strategy. It's they're doing synthetic covered calls, so it's a longer dated a long call, a longer dated short put, and then probably weekly. I guess like when it benefits them to have like a weekly uh, option selling routine. And then if you look through like the fine print again, I'm half joking here, like who the freak are these guys? The good news is that they're like I compared like the Curve investment with the Neos investments, so it's pretty much the same three gentlemen that are going to be managing this. So again, why the need for two separate company names? I know like there's sub advisors for YieldMax and Defiance, like the Pestricelli gentleman. He's also in both. But at least like it's two separate type of management company, so it's not that weird to have the same portfolio managers managing different things. But like this whole, I don't know, I'm not too sure. I like having like two separate brands. Why not just keep them both? Unless there's something that I don't know about, like maybe Neos is for maybe more like broad-based ETFs, and the similar to YieldMax, they might want like individual stock names under Curve. I'm not sure I understand the marketing logic there. But anyway, so I went through like the LinkedIn's and I copied some of the information here. So the good thing is they're not like total noobs. Uh, None of them have CFAs, but charter holders. But you know, I guess like they're co-founders uh, of like these different companies. So like for example, Garrett, he's a co-founder of like Neo. So I guess like, but again, like if they're a co-founder of Neos, why not just keep this name? Kind of weird, but again, I guess it's their. I guess in case like Curve, they mess up with Curve, I guess they can keep Neos as a separate thing to prevent them from, I don't know, like bad feedback or something like that. Sort of like I guess how like Gap owns like Old Navy and Banana Republic. So I don't know, maybe it's like that. Uh, but but anyway, I guess it's too soon to tell in terms of investment performance. Maybe they can squeeze out like a higher return. In that case, then the 1.15 basis point, 115 basis point might be worth it in terms of expense ratio. And I do mention that more competition in general is good for the space. But right now they have a lot of catching up to do. Tesla has a head start and they have a longer track record by a few months. And it's a good preview of to see how TSLP might do. Maybe they're like TSLP might suffer from the same nav erosion over time. So I wouldn't get too excited about TSLP just yet. Um, and I guess in general, it's good to have like some other forms of like investments that pay dividends, like such as treasuries, dividend aristocrats, in case this one doesn't work out either. And just like again, I'm not too thrilled with the higher expense ratio. I mean, right now it's a tie temporarily into 2024. But again, a similar risks, like where you don't have control over option strike selection. I would like to see more transparency. I guess like as time goes on, I would like to see them like show like a similar to how Yield Max like they publish like their trade results. Maybe they're still setting things up, so maybe that's why they haven't published much yet. Uh, I think over time, implied volatility could collapse for both TSLY or TSLP, and yes, the stock price of the ETF itself can get cheaper, so it's something to keep an eye on. Um, I don't expect the yields similar to TSLY, like the results won't be consistent month to month. You won't be able to borrow against them, at least not yet. So far, this one doesn't even have a track record yet. So hopefully, I wish them the best of luck. And so far, like no trade transparency, so it's not. I'm not too thrilled about that. But let's give them some time. Maybe over time, like they'll be a similar performance with TSLY. And if you consider giving this video a like and subscribe, I would greatly appreciate that. I do note that my subscribers will generally be healthier, wealthier. They're better looking, more well endowed, and all around good peeps. So thank you for watching, and have a great one, everyone.